Alright, what's up everyone? Welcome back to my channel. It's called Investing Sucks, and we like to talk about the part of investing that sucks. So today, we're going to be talking about how to read an annual report efficiently because, let's be honest, they're super long, they're full of technical jargon, they're boring to read, you don't want to read them, but you do have to read them because there's a lot of information in there that's good, but there is also a lot of information there that you probably don't need to read. So what I have on my board here is 7 different tips that I'm going to be going over that I've taught to people in the past, and they've all kind of said to me, yeah, these are really helpful tips, and they help me just skim through the information and kind of just focus on the stuff that I need to know. So anyways... Okay. Pump the brakes here for a second, Slick. So you actually read annual reports? Yeah. So you actually do like research on a company before you buy them? Well, yeah, of course. I mean, you have to. Like, that's how you understand the company. Okay, I mean, this is boring, man. I'm out of here. I mean, I don't know how you're doing that. Count me out. Okay, sorry about that, guys. I don't know who that guy was. But anyways, before I get into this video, if you do enjoy this type of content, I'd really appreciate it if you would consider subscribing to my channel. My goal is to hit 100 subscribers by the end of the year, and I'd really appreciate it if you would help me do that. But without further ado, let's actually get into this video. So I've got 7 tips that I'm going to go through. So I've got tip number 1 here, and that is skip the letters that are written out to the shareholders. So this is your letter from the chairman, your letter from the CEO, you know, because these letters are really just them kind of try to hype up their own company and talking about how good their results were, how proud they are of their employees and all the work they've done and all that stuff. So what you really need to focus on is, you know, the company's mission, vision, and strategy, if that is something that's really important to you. Now, some people say the only way you can understand those is if you actually go into the letters to the shareholders and read it. But that's not necessarily true. You can get a pretty good idea of that stuff if you read the MD&A section, which is Management Discussion Analysis. So this section, every annual report has to be included. Sometimes it'll be included outside the annual report, but usually you can find it in there. And that will talk about their actual, you know, operating highlights and what they plan to do going into the future. And that's something I'm going to talk about later. Also, just focus on financial highlights. The financial highlights section actually does get audited by auditors, and they do a lot of work to make sure that the information that's contained within there is unbiased and is really just a statement of facts rather than, you know, just them hyping up their results. So that's tip number 1. Make sure you keep that in mind. Number 2, and this is probably the most important one, is focus on free cash flow rather than just their net income. So if we think about it, net income has really just become kind of an accounting calculation, right? It can be manipulated in so many different ways. There's different expenses that can be included there that aren't really expenses. There's different revenue recognition principles that, you know, a company can recognize revenue even though they aren't going to be receiving the cash for it until later in the future. And really, as an investor, what you're focused on is how much money is the business generating from their actual operations, right? Cash flow from operations, or free cash flow, which is cash flow from operations minus capital expenditures. There's a lot of IFRS standards in there, which is International Financial Reporting Standards, that, you know, can really influence net income to the point where it's not really a reliable figure. And there can be a lot of non-recurring items in there. For example, you have a company that could report, you know, super high net income, but all they're doing is just selling off non-performing assets and selling off different divisions that they're no longer continuing with, which they're showing a huge gain on that. Or maybe there's some write-off and it's lowering their net income in that case. These are all things you need to be aware of. Okay, number 3 is there's a risk section. Every annual report will have a big laundry list of risks. Just focus on the risks that are unique to the company you're looking to analyze. There's a ton of risks in there that pretty much every company is going to have. Like, every public company has interest rate risk or exchange rate risk or cybersecurity risk. These aren't unique to certain companies. They may be more important to certain companies, in which case, yeah, maybe you'd want to read into that a bit. But in the most case, you just want to focus on risks that are specific to the company you're facing. So it's good to get an understanding of the risks that are usually included in there. And then from there, you can build up your knowledge and say, okay, this risk looks a bit unique. Now, specifically, you want to focus on litigation risk, because with IFRS, International Financial Reporting Standards, companies only need to include potential estimated losses due to litigation in their financial statements if it's, 1, probable that it will occur, so the likelihood is above 50%, and they can accurately estimate what the amount will be. If they can't do either of those, then they don't have to include it in their financial statements. So there could be a giant outstanding loss that could potentially occur in the coming years due to, say, product liability, for example, if the product they sold that went defective, or there's some lawsuit going on with that. The only way you're going to know about it is if you actually read the litigation section. So read the litigation section, make sure you understand all the risks that exist within the company and if there's any outstanding litigation that could cause potential significant financial loss. So number 3, and this one's pretty important, which I think most people do nowadays, but there are a lot of people who I talk to that kind of skip this thing over when they're looking to analyze a company, and that's reading the executive compensation section. So you really want to compare it to see if your competitors, or you want to compare it to competing companies, see how much executives are getting paid in relation to those companies, because that will tell you, are the executive more concerned with lining their own pockets or generating shareholder value? Because if they're getting paid excessively, that can provide an indication as to what their true priorities are. So that's one thing to keep in mind. Now obviously when it comes to executive compensation, packages vary all over the place, and you can interpret them in so many different ways, saying, well, this compensation is higher, but it mainly consists of stock options and not just salary, which they need to hit certain targets in order for those stock options to vest, and then they would exercise them. So that's one thing you can also look at. All right, number 5 is don't read all of the financial statement notes. So the notes to the financial statements are quite long. It makes up a pretty significant part of the annual report. You don't need to read all of them, okay? Now myself, I'm an accountant, which means a lot of the stuff in there is, accounting treatments, which you'd think someone like myself would love, but you really don't need to. If you're looking at it from a long-term value investing standpoint, do you really need to concern yourself with what type of inventory recognition method they use? I mean, some people might argue yes in some specific certain circumstances, but in reality, unless their inventory method is changing year to year, then you don't really need to read in depth on what it is. Now, even if their inventory method is changing year to year, that's called an accounting policy change, and they have to actually go back and adjust all their previous financial statements to make sure they all represent that same accounting policy. So it's not like they can even just keep changing their accounting policies, and one year it's this, next year it's this, and it's just constantly changing and it's showing manipulated results. That's not necessarily the case, okay? The accounting standards are on your side in that case. What I would recommend you do, though, is when you're looking at the cash flow from operations section, obviously you have all your changes in net working capital. If there is a really significant change in net working capital, then it's a good idea to look at that and say, well, this change was significant. Let's take deferred taxes, for example. Deferred taxes increase their cash flow from operations by $1 billion. Then yeah, you may want to look in the notes and find out what that was all about, because that's pretty significant, right? But you don't need to look at every single one, okay? If you really want to go in detail and you want to understand everything, then yeah, I get it. You want to read all of them, but in my opinion, if you're just trying to get a general sense of how the company's doing, you don't need to. Now, number 6 is to read the notes on revenue. You have to understand how the business generates money, right? And not only just kind of what their business model is in general, but also the countries that they sell in, the different products and services, and how much of their revenue is made up of those, because you can look at a company and look at kind of those trends throughout the years and say, okay, let's look at, the EMEA region. 5 years ago, that made up 5% of this company's revenue. Now it's up to 20. That could be a significant catalyst of their revenue growth, while all other countries are pretty stagnant. So if that region starts to stagnate, then their revenue growth into the future isn't going to be as high as maybe it was in the past. That's a pretty good insight to get, and the only way you're going to get those kind of insights is by reading the notes on the revenue. So make sure you read that, okay? It provides very valuable information, and a lot of people will look at revenue growth, right? It's really one of the first things you look at when you're analyzing a company, right? Is their revenue growing? Are they a growing company? Is it stagnant? Did it go up? Did it go down? These are all things that some of the first things that people look at, and reading the notes will provide you more insight into how to actually get a better understanding of that. Now, my last tip is to actually read the management discussion and analysis section, but you want to focus on forward-looking statements and review of past financial results. So forward-looking statements are when management details their strategy and their plan going into the future, saying, we expect that in the next 10 years, our sales in, say the Northwest are going to increase by X number, right? That's the type of stuff you can find in there, and it actually proves their assumptions as to what they're trying to say. Now, you obviously want to take it with a grain of salt, because those companies, they might present it a little bit biased. All the information isn't going to end up being true as well, so that's something you need to keep in mind. But if you're trying to build, say, a cash flow projection of them, it is useful to understand what their plans in the future are, so you can actually build your assumptions into that company's valuation if that's what you're trying to do based on what the company themselves are planning to do. And then a review of past results is very crucial information. So in my last video, I did it on Shopify, and I was looking at their stock kind of from a value perspective, and one thing they said was they don't expect their year-over-year revenue growth from the year 2019 to 2020 to be as high as 2020 to 2021, because it was kind of an anomaly year due to, that thing that happened. This is a very valuable insight that you can find in the management discussion analysis section, because if the company themselves is saying, we don't expect revenue growth to be 100% year over year again, but then you look at the stock's valuation, you say, well, investors are really projecting a lot of growth into this company, then you can say, maybe they might be overvalued. Because if the company themselves are even saying that, then it provides a pretty good indication. So anyways, guys, those are my 7 tips. I hope you enjoyed this video, and I hope you found it very informative. So with that in mind, just thank you for listening, and I'll see you in the next video.